Stocks continuing to climb higher as investors await not just that next decision from the Fed, but any signals from Chair Powell about rates for the rest of this year. Stocks holding on to last week's gains with the market buoyed by big tech earnings, focusing on company news rather than economic data showing stickier inflation. So given this backdrop, how should investors be playing the Fed decision? We have Jordan Jackson, JP Morgan Asset Management Global Market Strategist, right here with us. Jordan, thanks for popping in during that smooth transition there. I really appreciate it. I know you just heard Miles talking a little bit about how the market wants to kind of ignore the Fed, move off of tech earnings. But for those in this market who are paying attention to the Fed, how should they be positioning themselves ahead of this week's meeting? What should they be thinking about and doing differently?
Sure. Well, I think there's real risk that the Fed's not going to be able to cut rates at all this year. One, when you look at, and I tend not to focus on the year-over-year numbers on inflation, but when you look at 3-month annualized run rates, they're super core services ex-shelter inflation. That's running at 8.2% on a 3-month annualized basis. When you look at the labor market, right, we're adding roughly 275,000 jobs on a 3-month moving average basis. If we get to a level of around 150,000 jobs and fall below that, that will put upward pressure on the unemployment rate. But right now, we've got job growth that's putting downward pressure on the unemployment rate. So these are, and obviously the Fed targets labor markets and inflation, and these are just dynamics in which they're not in a position to be able to cut rates. I also don't think they're going to want to cut rates so close to the election. If you look historically, they have cut rates within 2 months of the election 3 times, 84, 92, 08. In 08, we were in a recession. In 92, these were continued cuts as a result of the 1990-1991 recession. And then the 84 cuts was a reflection of inflation having surged in the first half of the year and then began to stabilize in the second half. So you can explain away economic reasons, why they'd want to cut rates. But if this data continues to deliver the way it's been delivering over the first quarter into the second quarter, and then we're now into the election season, I think at best they may be able to squeeze a cut in December.
And if they hold off on rate cuts until December, maybe not even cut at all, like you were saying, is the other possible scenario here this year. What then do you think 2025 looks like?
I think it looks like shallower rate cuts potentially. Now, obviously, if something breaks, they're going to cut rates more aggressively. But right now, we're probably looking at somewhere between 3 and 4 cuts over the course of 2024, and I'd argue that number is getting 2025, excuse me, and that number is getting dialed back a little bit.
How big of a risk is that then to the stock market, particularly given that a lot of these large cap companies, they don't have to worry that much about higher for longer because it's the small caps that have a lot of debt that they're going to have to worry about refinancing. So what is the extent of the potential downside in a higher for longer environment?
I think equity markets can stomach it so long as we're still talking about cuts and not talking about hikes. And this Fed seems committed to wanting to embrace cutting. If you actually look historically in the modern Fed era, let's say going back to 1980, they've never been on a prolonged pause after hiking rates and then went back to start hiking rates again. They've always delivered a cut to some degree. So I think there's still this sort of implicit as well as explicit bias via the dot plot to want to begin to start cutting rates at some point. But crucially, in a higher interest rate for longer environment, earnings becomes that much more important. And one of the things that we've observed is that, obviously Mag 7 earnings growth were very, very strong last year. They're expected to decelerate, but the rest of the markets expect earnings growth is expected to converge upward. And I think that's really, really important.
I'm curious what you've made out so far, just some of the commentary that we've gotten from executives on earnings calls this earnings season when it comes to their expectation that the Fed is going to cut. Yet when you take a look at what the market is pricing, even when you take a look or listen to what Fed Chair Jay Powell has been saying, it seems it's actually becoming less and less likely, to your point, that the Fed is going to cut. What kind of pressure does that put on the fundamentals of the businesses and then ultimately the pressure that could, I guess, put on the broader equity market then down the line?
To some degree, it cuts both ways, right? Because you look at these big companies, these large tech companies, they're sitting on a lot of cash, and that cash is yielding them something. Mm-hmm. So it's actually generating something positive for the businesses. And that's why you've seen a lot of talking from the forward guidance about CapEx picking up, spending intentions beginning to improve, which is a very generally I argue supportive backdrop for equity markets. But on the other end, as you've highlighted, small cap companies are sitting on a lot of debt. They have about 40% of their debt is floating rate, so they're very, very sensitive to this interest rate reset, and so they're probably going to be dealing with a little bit more challenges, which is why we skew our portfolios to be a little bit more defensive, a little bit more larger cap in nature in this higher for longer dynamic.
Well, going off of the earnings conversation, we are halfway through this first quarter earnings season, and I'm curious about how you're viewing what we're hearing specifically about inflation on these earnings calls. I think about Walmart executives saying that prices for the first time since COVID are looking similar to 12 months ago. Do we buy that? Do we buy the commentary about inflation waning and a strong consumer?
I'm not so convinced that inflation, where this disinflationary trend is going to magically play out. You know, I've always been of the opinion, if you are a consumer, inflation is your foe. If you're a business, inflation is your friend, right? It's sort of a reflection of pricing power that you have. And particularly in an environment where consumers are spending, the unemployment rate's low, the economy is still strong. I know the headline GDP number wasn't great, but when you look at real sales, real final sales to private domestic purchasers, so that strips out inventories and exports, the economy grew over 3% in the first quarter, right? And so I think this is a potentially demand-driven pricing power that businesses have, i.e. they can still raise prices modestly and still have people come through the door and buy.
So given the demand trend that you've been talking about there, given the patterns that we've seen, the trends so far this earnings season, and also obviously coupling that with the Fed and the expectation there, where are you seeing the most opportunity to put money to work today?
Yeah, sure. So we actually like sort of energy in this environment. We think there are some risks that potentially oil prices could move higher in the near term, but we like energy. They're being much more shareholder friendly. It's not just drill, trying to be a little bit more efficient with their balance sheets. I think that's important. Even looking at tech is still, I think actually could be a little bit more defensive this time around. I'm going to keep in mind, we got
even
strong,
the Mag 7 names?
Even the Mag 7 names, strong balance sheets. Oh, and by the way, a couple of them have just started issuing dividends. Right. We haven't seen that. We've never seen that, right? So I think, you know, these business models are changing. They're becoming a little bit more mature, but they're also still investing in a big way. So again, still kind of leaning defensive. We like pockets of healthcare, consumer names, consumer-driven names as well. And then I also think another interesting sort of maybe second derivative, if the AI craze is real, and we know it is, it's here, I think we should maybe start to think about the electricity uptick that it's going to demand. So electricity providers, power grid infrastructure players, I think that could be a really interesting way as sort of a second derivative play on the AI theme.